What is a Robo Advisor, and should they manage your investments? Should you trust a computer program to rebalance your portfolio? And what are the 5 things you should consider when selecting a Robo Advisor? We'll answer these questions and more on this, the 132nd episode of the DoughRoller Podcast.
Welcome to the DoughRoller Podcast, where the best thing money can buy is financial freedom. We help you make more, spend less, and invest the rest. And now your host, Rob Berger.
Whether you're just starting out, buried under a mountain of debt, or well on your way to financial freedom, this is the podcast that can help you take your finances to the next level. Hey, everybody. Hope you're having a great Thanksgiving week. I'm a day away from hopping in the car and driving that 7-hour drive back home to Ohio for Thanksgiving. This is going to be the first Thanksgiving that I'm not with my son, number one. That's sad. And actually, my wife and daughter are going to her parents. They can't make the trip to Ohio, so we're kind of all on our own this year, and that's a bit sad. But these things happen, and what are you going to do? So that's what we've got planned, and I thought I'd get a couple of podcasts recorded and published this week, hopefully somewhat in advance. Perhaps if you've got a long trip and, I don't know, you've exhausted all of the other podcasts that you listen to and you're down to just one more, maybe I can be there for you. And today we're going to talk about Robo Advisor. Some of you are thinking, finally, Rob, I've been emailing you and I've wanted to get your thoughts and your take on Robo Advisors. And the rest of you, probably 90% of you, are saying, what in the world is a Robo Advisor? Well, we are going to answer that question today. What we're going to do today is I'm going to put Robo Advisors into some context. We'll talk a little bit about individual Robo Advisors, but this podcast is going to be more of what they are, what do they do for us, should we use one, what are the pros and cons, how should we go about evaluating whether we should use a Robo Advisor to help us with our investments. And so that's going to be the plan. I'm actually going to do another podcast in about a week that actually walks through the more popular ones and talks about the pros and cons, how much they cost, how they work, my take on them, that sort of thing. And so that's the goal for today, though. We're going to kind of attack this from a high level. And I've gotten a lot of email on Robo Advisors, and let me just share 2 of them with you as sort of an introduction here. The first came from Ace. We've heard from Ace before. He said, I am currently using Betterment for my wife's and my Roth IRA. I have been maxing out Roths for years, but just started with the TSP this year. After looking into it, and that's the government thrift savings plan. It's the federal government's 401k, effectively. He says, after looking into it, the TSP's expense ratios are incredibly low. If I am looking at it correctly, it is 2.9 basis points, 0.029%. That's starting to make me think that I shouldn't even contribute to our Roth IRAs anymore and just put all the money into the TSP. They have Roth options as well. Thinking about this has got me thinking about Betterment. How is using Betterment any different than using a paid-for advisor that makes all my investment decisions? Actually, with Betterment, I have less choices than if I paid an advisor. Obviously, the cost is the biggest difference. But after that, I'm wondering if I'm giving up too much of my decision-making power by using Betterment. I don't think there's any way to know that their selection of ETFs are better than me using a strict S&P index fund mixed with a government bond fund to make my asset allocation where I want it. Do you have any thoughts on this? Thanks again for everything. So that's the first email, and great questions, Ace, and I will do my best to address them today. And then Ursula wrote in. She said, my question is regarding Future Advisor. What's your take and opinion on it? To give you a little background, I use Mint.com, but Mint, for some technical reason, does not sync with my 401k. As I was reading through the comments on Mint's site of people asking why it isn't fixed yet, and it's been apparently an ongoing problem for a few years now, some commenters mentioned Future Advisor, which does include my 401k in the overview. So to get a whole view, I also ended up signing up for the basic account with Future Advisors, which is free. It's great to see my overall financial profile, including the 401k. However, Future Advisor also has a list chock full of suggestions to make my portfolio better, stronger, more growth in the future, etc. It recommends selling off a bunch of stocks and bonds, including the funds in my Vanguard Roth IRA and some of the Betterment allocations. I'm confused as I know how everyone is riding the Betterment train, including myself. However, it did get me wondering, what if Do you have any experience with Future Advisor or comparisons, contrast to Betterment and other popular financial services as such? Thanks so much in advance for your thoughts on this. And I'm looking forward every week to a new podcast. Well, Ursula, thanks for the email. Another great question. So I'm going to do my best to answer some of these questions, or at least give you my opinion on them. Some of them I'll probably address in about a week when I really do a podcast focused on comparing and contrasting each of the different popular robo-advisors. But let me do this. I'm going to start out with just sort of some rough responses to Ace and Ursula's emails. And then we're going to dive into, again, sort of a high-level view, my view of robo-advisors. And by the way, again, for those that the robo-advisor term, these are basically companies, websites that will help you invest. You take Betterment, for example. You can open an account at Betterment. You send in your money, whether it's a retirement account like an IRA, Roth or traditional, or you could have a taxable account. That's what I have at Betterment, is a taxable account. All you do is select the amount you want in stock, funds, ETFs, and the amount you want in bond ETFs. And then Betterment divides that money up into a series of ETFs. They show you what they are, but it's the same for everybody. So if you picked 70% stocks and 30% bonds, and I picked the same thing, they would invest our money in the exact same ETFs. They do that for you. They rebalance for you. They reinvest your dividends. You're done. You pick the stocks and bonds split, and they do everything else for as long as you have your account with them. And not all robo-advisors work exactly like that, but they basically do the same thing, although they do it in different ways, and those can be very important, as we'll see. So let's think about that for a minute, and let's kind of address Ace's question. First of all, let me just say, and I'll do a podcast just on the thrift savings plan. This federal government 401k has, without question, the lowest costs of any 401k, any investments that I have ever seen. I mean, it's ridiculous. I have a good friend that works at, he's a lawyer at the Justice Department, Main Justice in D.C., and so he every now and again I'll say we'll have lunch. So remind me again, what are the expense ratios? They're how low? I mean, it's almost as if they're paying the employees to invest for. I mean, not quite, but I mean, it's as low as you can get. So if you're with the government, it's an absolutely phenomenal plan. Now, with Betterment, one of the things Ace mentioned is, I don't have any investment choices. I mean, I can pick stocks versus bonds, but then Betterment does the rest. I can't say to Betterment, yeah, I see your asset allocation plan. It's okay, but can we tweak it a little bit here, and can I have a little bit more moved over there? How about a little more international or whatever? You can't do that. So that's a good thing and a bad thing, right? I mean, it's a good thing in the sense that it's designed to be easy, hands off. I think it's a perfectly good, solid asset allocation plan, but it's not the only option, right? And maybe if you were constructing it yourself, or if I were constructing my own asset allocation plan myself, which actually I am, I might do things a little different than Betterment. But I certainly think Betterment's is a good one. But it's, the trade-off is you can't slice and dice your asset allocation plan exactly the way you want it. You've got to do it the Betterment way. And that's by and large true with most robo-advisors, although there are some exceptions. But that's by and large true for most robo-advisors. And the reason for that is it's how they make it easy for you. I mean, if you could just go in and say, well, wait a minute, I want to do this myself, you might as well just go to Vanguard or Fidelity and just do it yourself, right? So there's definitely that trade-off. And if you're someone that really wants to focus in on and have a very specific asset allocation that you think is best, then a robo-advisor is probably not the right option for you. On the other hand, if you're like, yeah, I'd prefer to go do other things with my time, then, I think these might be good choices. But Ace, you're absolutely right. You're giving up some flexibility. Now, as regard to robo-advisors versus an actual human being advisor, you really answered your own question there, Ace. The cost is the biggest difference. That's absolutely the biggest difference. We're going to talk a bit about costs today, but there's no question that a robo-advisor is going to cost you a lot less than an advisor. The question becomes, are there other benefits that a human being, an advisor, can offer that a robo-advisor can't? And do you need those things? And those are good questions. Oftentimes there's the view that a human being, an advisor, will talk you out of doing dumb things with your investments. So when the market crashes, they will talk you out of selling your investments and running and hiding. that may be true for some. It may not be true for others. A lot of people like to say that's true, except that when I talk to advisors, they tell me how much business they lost in 08 and 09 because all of their clients left them and cashed out of the stock market. So I'm not at all convinced that hiring a human being to manage your investments will keep you from making mistakes with your money. Maybe it will, maybe it won't. That's a decision you have to answer. But yeah, the biggest difference is the cost. And that's a huge difference because advisors easily, will charge 1% or more. Not all of them, but it's probably the average. And so that's the biggest difference. Now, to Ursula's question, it's kind of interesting that Mint won't sync up with her 401k. Future advisors will, she says. I'm guessing Personal Capital, which is the tool I use to track my investments, probably would too. But as she mentioned, Future Advisors does more than just track your investments, as does Personal Capital for that matter. But Future Advisors also made a bunch of recommendations for her of stocks and bonds she should sell. And we're going to talk a bit more about that as we move through the show, but that is a pretty neat feature of Future Advisors and something that I like quite a lot. JemStep, which is another one you may have heard of, and I actually interviewed folks from JemStep. And let me quickly pull up that podcast number. Here we go. I interviewed Simon Roy. This was podcast 32. Man, that was a lifetime ago. DoughRoller.net/podcast32. I interviewed the folks from JemStep. They do a similar kind of thing as Future Advisors does. And let me just briefly explain it again. We're going to talk more in detail in about a week on this. But you can plug in your portfolio to Future Advisors. You can enter it manually, or you can give them your username and password where all your accounts are. And just like Personal Capital, if you've used that, it'll bring in import all of your investments. It'll slice and dice them, and then based on a couple of questions they ask you, when you're going to retire and all those sorts of things, it will not only recommend an asset allocation plan for you, but then give you specific step-by-step instructions. You should sell this fund that you have and buy this one. You should keep this one. You should sell that one, and exactly what you should sell and buy. Now, of course, you don't have to take that advice, right? And you could also, one of the things I found, I have individual stocks, of course, that come into this. And what Future Advisors recommends is I sell them all because they don't recommend that you own individual stocks. But one of the neat features is you can say, yeah, I appreciate your suggestion that I sell my Apple stock, but I'm not going to do that. And you can hit a little lock icon that locks that investment that tells Future Advisors, yeah, Rob's not going to sell his Apple stock. So can you recalculate your plan with that in mind? And it'll redo the plan. Okay, you don't want to sell your Apple stock. Well, that may change a few things. And so it'll redo the plan for you. And I find Future Advisors to be a fun tool to use as a way to kind of give your asset allocation plan a checkup to see, at least what they think of it. It doesn't mean that you should, and please don't do this. Please don't blindly follow any Robo Advisor's advice when it comes to your asset allocation plan. We never want to turn our brains off here. Take the information they give you, think about it, see if it makes sense for you. But that's one thing that Future Advisors does. Now, it does a lot more. Again, we're going to cover more of that in about a week. But it does make those suggestions, and I think their suggestions are pretty good. And again, we'll talk more about that. Okay, so let's move past those specific robo-advisors, and let's think about generally what they do. So when we think about investing, as an investor, we basically have to do 5 things. Really, I'll call it 4.5, but I'm going to list 5. You'll see what I mean. The first is develop an asset allocation plan. At least, hopefully, we're doing that. Actually, when I first started investing, I don't think I had an asset allocation plan. I don't think I knew enough to have an asset allocation plan. I just picked a fund. But eventually I figured out what I was doing. And so the first thing is we want an asset allocation plan. I've talked about that, about building one. You can check that out at podcast 25, DoughRoller.net/podcast25. So that's the first thing we as investors do. Now, we don't do that often. You do it once and it should serve you well for many, many years. But that asset allocation plan certainly will change over time as you near retirement. So, it's not just developing it initially, but it's evaluating it and perhaps changing it over time. That's the first thing we want to do, right? Number 2 is we want to choose mutual funds and ETFs to execute on that plan. So we've got our stock allocation, our bond allocation, U.S. stocks, foreign stocks, maybe some emerging markets, REITs, commodities, whatever your asset allocation plan is. Now we've got to figure out, okay, well, which funds or ETFs do we want to select to execute on that plan. That's step 2. I've talked about that as well, podcast 26. And then the third thing, and this is kind of why I called it 4.5. This could be 2B if you want, but I've listed it as 3. We need to actually make those investments. We need to actually buy those funds or buy those ETFs. I separate that out because it really is kind of a separate step. I mean, you've chosen the funds and ETFs you want, but if you're like me and like a lot of people, now when you go to buy them, it's not quite as simple as simply clicking a few buttons on a website. You have to start thinking about things like, well, wait a minute, which accounts should I hold this in? I might have a 401k, I have an IRA, maybe you have a Roth, maybe you have some taxable accounts. Where do I put all of these funds? It's not just buying them. I got to figure out where I'm going to buy them. And that's not always an easy decision, or it's actually, it's not that difficult, but it takes some thought. And I've gotten it wrong before. As I mentioned in a previous podcast, I've got a commodities fund and a retirement account. Commodities funds don't generate income. I don't know why I have that in a retirement account. That was a mistake. Anyway, once you've got your asset allocation plan, you pick the funds and ETFs you want to buy to execute that plan. Then you got to actually buy them and figure out where you're going to hold them. All right. The fourth thing is rebalancing, right? We have the plan, we buy the funds, the ETFs, but as the market performs and our investments go up and down, they get out of balance. They deviate from our plan. So every now and again, we need to rebalance those investments. Again, I've talked about rebalancing, podcasts 51 and 52. And I kind of include in rebalancing dividend reinvestment. I think for most of us, dividend reinvestment happens automatically. That's certainly true with mutual funds. It's certainly true with ETFs at Vanguard. Not all ETFs automatically reinvest dividends. That's something to know. The Vanguard ETFs do. So I kind of include that as part of rebalancing. For most of us, it happens automatically. But rebalancing is an important part of what we as investors have to do or should be doing. And then the fifth thing that I've listed is focusing on tax efficiency. Now, part of that is where you invest in your funds, what accounts you use to buy your funds. We talked about that in step 3, but tax efficiency goes beyond that. There could be tax loss harvesting if you have taxable accounts, and I've done that before. Sold an investment at a loss to get the tax benefits, and then reinvested the money in something else. So tax efficiency, again, for those that have taxable accounts, is a very important part of all of this. So, you might divide what an investor does a little differently than I just did, but I think at a high level, those are sort of the 5 things, main things that we as investors have to do. And when you think about those and you say, okay, well, how does a Robo Advisor help us with any of those things? And the fact is, Robo Advisors can help us with virtually all of them if we want them to. And on the other hand, some robo-advisors can help us with just a couple of those things. It really depends on what you want to accomplish. We're going to walk through that. But let me give you a couple of examples from some robo-advisors that we've already talked about. Take Betterment, for example. If you open up an account at Betterment, you have to pick between the amount of stocks and bonds you want. But after that, it basically does everything. It has the asset allocation plan. It picks the mutual funds and ETFs. It invests that money. Now, you're going to have to decide whether it's a taxable account or an IRA at Betterment, but it will invest the money in the various. They use ETFs. It reinvests your dividends automatically. It rebalances for you automatically. And if it's a taxable account, depending on how much you have invested, they have different levels of service, but they have tax loss harvesting available. So they have sort of the tax efficiency issue covered. Betterment kind of does it all. Now, compare that to Future Advisors. Future Advisors has sort of 2 levels of service. It has a free service where, as I mentioned, you can evaluate your asset allocation plan. It will give you suggestions. So it would cover the key phase of developing your asset allocation plan. That's a free service, and you can just stop there. That's all I want you to do. I'll buy the funds. I'll rebalance. I'll worry about tax efficiency, but I just want some help with my asset allocation plan. Then you could just stop there with Future Advisors, or you can take it a step further and say, you know what, Future Advisors, I do want you to do everything. I want you to manage my investments. I want you to do the rebalancing. I want you to worry about tax efficiency. And you can take it to that next level. It's a premium service at Future Advisors. And then if you do that, just like Betterment, there are fees their costs associated with it. And so those are two examples where Betterment's sort of all or nothing. They handle everything or they don't handle anything. Future Advisors has sort of two levels of service. So those are examples of how at least those two robo-advisors cover those sort of five main tasks that we as investors should be doing. Now, let's take a step back for a second. You know, before the term robo-advisors ever came into being, and before Betterment and Future Advisors and Personal Capital and Motif and JemStep and Wealthfront and Wise Banyan, I could go on, all robo-advisors ever came into being. You know, there was a robo-advisor. Wasn't called that, but it did all of those five things that I just described. What is it? It's a target date retirement mutual fund, something you've probably heard of. You stick all your money in a fund, right? It already has a built-in asset allocation plan. All you have to do is pick which one you want. Oftentimes, they're named by the year you're going to retire. Not that you have to pick that one, but if you're going to retire in, 2050, will people be retiring that late? Yeah, sure. So if you're going to be retiring in 2050, you could just pick the 2050 fund. You're done. It allocates all of your investments to, I think, 3 to 5 individual mutual funds is usually the case, depending on which target date retirement fund you choose. It invests the money. It rebalances. It reinvests the dividends. It does everything for you. A target date retirement mutual fund. Vanguard offers them. Fidelity offers them. I think all of the major mutual fund companies offer them. And they are, they existed long before robo-advisors. And it raises an interesting question, and that is, well, then why robo-advisors? Why was there a market for what robo-advisors are offering? And there is a big market. I mean, Personal Capital, I think, is almost at $1 billion in assets under management. They're kind of a quasi robo-advisor. We'll talk more about them in a week. Betterment's approaching $1 billion, I think. Wealthfront. I mean, there's a lot of money invested in these robo-advisors. So why not just stick with a target date retirement mutual fund? Well, a couple of thoughts there. One is, I think a target date retirement mutual fund is a perfectly good option. There's no reason. I think it's one of many reasonable choices. That being said, there usually are additional fees associated with a target date retirement mutual fund beyond just the underlying fees of the funds. Depends on where you invest. But you can actually find robo-advisors that are cheaper than some target date funds. That's one thing. I think robo-advisors have done, frankly, a better job at educating investors about asset allocation and about their portfolios. When you go to these sites, whether it's Wealthfront, JemStep, Betterment, all of them, they've done a really good job at building their websites, and they have tools that make understanding asset allocation and investing and risk much easier. And in that sense, I think they've bypassed a lot of the mutual fund companies. I think some of the mutual fund companies, and I wouldn't even include Vanguard here, kind of missed the boat on this. And I think that some of them are trying to play catch up. I think Schwab has announced that they're going to introduce their own sort of version of a robo-advisor. Frankly, I'm stunned that Fidelity and Vanguard haven't done this by now. Really don't understand that. What Vanguard has done is introduced an advisory service where you have a human being that can invest your money. I think there are minimums required, but it's 30 basis points, and maybe that's just their approach. They may just say that, look, we want a hands-on approach, and that's fine. But I think the robo-advisors have done a very good job with the websites that they've built to help educate investors. The other thing is robo-advisors, depending on which one you select, have more flexibility than a target date retirement fund. I mean, Ace mentioned that Betterment doesn't have a whole lot of flexibility, but it's interesting. They have more flexibility than a target date retirement mutual fund, where you have certain buckets you can put your money in. That's it. I mean, at least with Betterment, you can absolutely, down to the percent, select how much you want in stocks versus how much you want in bonds. So, is that flexibility important? Well, for some people it won't be. And that's fine. For some people, it will be. That's okay, too. I don't think there's a right answer there. But certainly, I think the robo-advisors tend to have somewhat more flexibility than target date retirement funds. The other thing is that some robo-advisors, not all of them, but some of them will work with your existing investments. Whereas with a target date retirement fund, if you're not in one, you've got to take whatever money you've got and move it in there. Now, you're talking about generally an IRA. So there's not going to be any tax consequences of moving your money, and that's fine. But if you want to keep your existing investments, at least to some extent, you can do that with some robo-advisors. Again, you might be able to do that with future advisors. You can't do that with Betterment. So that's where understanding the differences is important. So, I wanted to kind of point this out, though, because what robo-advisors are doing for investors is not a lot different than what target date retirement funds do. They do it, it's a little slicker. The websites are pretty cool. They slice it and dice it a little differently. But at the end of the day, that, a target date retirement fund does basically the same thing. So, having said all of that, if you're thinking about a robo-advisor, what factors should you consider? What should you think about? Well, I've listed 5. First of all, what do you want it to do for you? Again, do you want it to do everything? You set it and forget it, right? That's kind of the idea. I want to put my money in. I may select the how aggressive I want them to be on my behalf. I may pick the stocks versus bonds. But after that, I want you to do everything. Is that what you want? So that if you do that, that's going to affect maybe which ones you pick, as opposed to, no, I just want help with my asset allocation plan, or I really just want someone to track my investments and maybe evaluate them from time to time. So that's an important decision to make as you think through which robo-advisors might be best for you. Again, we've talked about that, for example, Betterment versus JemStep. If you're just tracking your investments, my favorite is Personal Capital. So that's the first consideration. As part of that, the second thing, or part of this first consideration is, do you want them to handle all of your existing accounts? This gets tricky. Let me explain what I mean. Most robo-advisors cannot manage your 401k. You can transfer your 401k to an IRA. Let's say you're leaving your job. You want to roll over your 401k to an IRA. All of the robo-advisors will gladly accept that rollover into an IRA. But if your existing job, you're not leaving, you're still there, you've got your 401k, you can't have Betterment manage that 401k. You can't have Wealthfront manage that 401k. Most of the robo-advisors cannot help you with your existing 401k. And frankly, that's a big frustration because, it'd be nice to have someone that could just handle everything. Now, there is at least one potential exception to this, and that's future advisors. Future advisors can actually manage your 401k if it's at the right place, specifically Fidelity. Fidelity has something called a brokerage link, and it allows you through your 401k to basically invest in anything you want to beyond the funds that your employer offers in the plan through Fidelity. If you have your 401k at Fidelity and they have the brokerage link option, future advisors can actually manage that for you. So they're the one exception where at least potentially they can handle all of your accounts. So that would be an important consideration if that's important to you and you happen to have your 401k at Fidelity. But again, the key issue here is, what do you want the robo-advisor to do for you? You need to answer that as you begin to evaluate your options. Number 2, cost. Cost is always important. I have found that generally robo-advisors charge between 15 and 50 basis points over and above the cost of the underlying ETFs. They almost all invest in ETFs. So the 15 to 50 basis points is over and above the underlying costs of the ETFs. And in some robo-advisors, the actual cost depends on how much you have invested with them. That's the case at Betterment. Betterment, the cost range from, I think, 15 to 35 basis points. Some robo-advisors, it doesn't matter. Wealthfront is 25 basis points, period. It varies. You need to understand that. But again, costs are always an issue, always a factor to be considered, and that's true here as well. So that's the second thing. The third thing is, what kind of accounts do you want them to handle? Are they handling just retirement accounts, or are they also handling taxable accounts? And the big reason that's important is, for taxable accounts, you need to think about tax loss harvesting. Each of these robo-advisors, are the ones that I'm most familiar with, have algorithms in place to maximize your tax savings in a taxable account. And some of them, those tools are only available if you have so much invested with them. So if you're going to have taxable accounts, you want to look at that. The other thing is, Some of them, and I have one in mind, Wealthfront, offers a pretty unique tool. So they can invest, rather than investing in an S&P 500 ETF, they actually have a tool that will invest in each of the 500 companies. So you're owning individual stocks by capitalized weighted, just like an S&P 500 index fund, of all 500 companies. Now you say, well, why in the world would they? That seems like a lot of work. Why in the world would they do that? Well, tax loss harvesting. As any one company in that S&P 500 is at a loss, they can sell that. And I don't know exactly how it works behind the scenes, but they can sell that. You'll get that loss for tax purposes, and then at some point they obviously reinvest it. I don't know if they wait for those 30 days for the wash sale rule or how they do it. Now, one key there is you have to have at least $500,000 in the taxable account with Wealthfront. So a lot of money's involved here. But the point is, if you've got taxable accounts that you want these folks to manage, that has to be a factor that you consider before making your selection. They all tend to have tax loss harvesting tools. They all work a little differently. Wealthfront has that one tool that I mentioned that's unique. And for some of these tax loss harvesting tools to come into play, you have to have a certain amount of money invested. That's the third thing you want to consider. The fourth thing is, do you have existing taxable accounts you want to transfer to a Robo Advisor? Now, why am I focused on taxable accounts? Because there could be tax consequences. If you're dealing with an IRA, you can transfer an IRA from one broker to the next or to a Robo Advisor. There are no tax consequences. It doesn't matter if you have to liquidate your account, sell your investments, and move it as cash or not. It's in an IRA, so there are no tax consequences. But for a taxable account, there could be. And here, the Robo Advisors aren't all the same. For example, if you want to invest a taxable account in Betterment, and you have your money at Fidelity at the moment, you have to sell those investments, move the cash to Betterment, and then invest with Betterment. You're going to get potential tax consequences for doing that. You can't move the investments over in kind. But you can with other robo-advisors. Future Advisor, for example, if you one of the custodians they use is Fidelity. So if you had your money at, say, Vanguard, and you wanted to have Future Advisor invest your money, you'd have to move it out of Vanguard. One option is Fidelity. You can usually transfer those assets in kind and avoid the tax consequences of selling those investments. So if you're going to be moving taxable accounts, you'll want to consider the tax consequences and consider the different robo-advisors' approaches to those transfers. The fifth thing is, and the final thing, and there'll be other factors, but these were, to me, were the top five. Do you want to work with a human being, an actual advisor? These robo-advisors generally don't work that way. Not that you can't call them up and talk to someone, but you're not going to have a human being, for the most part, assigned to your account and talking, and someone you can call up every week or every month with questions. If you want an actual human being advisor, most of the robo-advisors aren't going to be for you. Now, Personal Capital, I called it a quasi robo-advisor. It has all the cool tools that come with the free dashboard. But if you actually invest with them, they assign a human being to you. You have an actual real live advisor. That's why I kind of call it a quasi robo-advisor, because you have a human being with you. But most of the robo-advisors don't. So if you're looking for an actual advisor, you'll want to factor that in to your decision. Now, so having said all of that, what's my take on this? So I've come to the belief, and I've been managing my own investments for over 20 years. I've been rebalancing on my own. I've been doing it the hard way. I'm ready for a robo-advisor. I'm ready to offload not so much the asset allocation plan, although I recognize that if I used a robo-advisor, I'd have to use their approach, and I'd be okay with that. I mean, I've looked at their asset allocation plans, and I think they're all generally consistent with my view of investing, and maybe not perfectly, but close enough. But I'm just tired of the rebalancing. It's a pain to rebalance. I'd much rather just have someone else do it for me. So I am ready to offload, particularly the rebalancing part of investing. There's no reason that a computer algorithm shouldn't be doing that for all of us, frankly. And so I'm ready to do that. The problem is I don't see how easily at the moment to get all of my investments into one place in a way that I'm comfortable with. And I have 401k at Fidelity. I have Vanguard assets. Now, I could use something like a Future Advisor, and I do have an account there, although they don't handle my investments right now. So I'm looking at them. But I'm just not ready to pull the trigger. I'm kind of waiting to see how this space develops a little bit more before I make any big decisions. One of the things with the Future Advisor is I'd have to move my accounts from Vanguard, and that's not to say I wouldn't have money invested in Vanguard ETFs, but I'd have to move my accounts from Vanguard. I'm just not ready to do that. I've been with Vanguard for a long time. I have a high level of service there. I get free trades on my brokerage account, and I have a lot of history there. I'm just not ready to make that decision. At the same time, I'm not ready to use Vanguard's advisory services for 30 basis points, in part because they couldn't manage everything. They can't manage my 401k. So it's like, well, yeah, you'd help me with what's at Vanguard, but I'd still have to do all the same work for my Fidelity investments. And so I'm not sure it really, in the end, it wouldn't help me. It's kind of like, for me, if I can't have it all being handled, handling half of it just doesn't get the job done for me. So I am absolutely ready to offload the rebalancing. I just don't think the industry is to the point yet where it's ready to happen. Now, maybe when I retire and I move my 401k over to Vanguard, maybe then I'll just hire their advisory services. I don't know yet, but I'm absolutely ready to offload the rebalancing. It's a pain. It's a pain. I've done it. I'll continue to do it, but I'd rather not if I could find a very low cost alternative. I don't know what low cost means exactly. I'm a big stickler on fees. That's the other issue. Would I want to give up 30 basis points, and I'd have to evaluate what I think the benefits to me would be, and would I maybe earn a little extra because they're rebalancing more often, and maybe they've got some tax loss harvesting tools that I can't take advantage of on my own. Maybe that would make up the difference. Those are things that I would have to figure out. But at the end of the day, asset allocation plans, picking funds and balancing, it's a commodity. I mean, the days of paying an advisor 1% or more to do this for you, they should be over, frankly. And in fact, I'll tell you, one of my concerns is this. When you follow the investment advisory world, my guess is most of you don't. That's fine. You've got better things to do with your time. I kind of follow it. When you follow it, you realize that that investment advisors are worried about Robo Advisors and the Vanguards of the world that offer advisory services for 30 basis points, because they realize that over time, and particularly as younger folks become middle-aged and have more money to invest, and they're comfortable with computers and they're comfortable with Robo Advisors and all these sorts of things, they recognize that the days of charging 1 or 1.5% for a basic asset allocation plan and investing their clients' money, they're numbered. They're numbered. That's not to say that they'll go away completely, but I think that it's going to be more and more challenging to find enough clients, to have enough assets under management, to have a sustainable practice charging that kind of money. My concern is this. They're going to start doing things to try to convince people that if you stick with them, they can beat the market. They'll say things like, yes, I invest in actively managed funds. And yes, you're paying me 1.5%, and the expense ratio on these funds might be 1%, but we'll beat the market. Or then what I hear is, well, we might not beat the market, but our lows won't be as low as what others are. So in 2008, when people lost all that money, they lost 35%. We only lost 25%. We'll smooth out the dips. They'll start to do things to try to distinguish their offerings, from these low-cost Robo Advisor and Vanguard advisory services. And I think they'll snare a lot of people. I think a lot of people will buy into that, and I don't think in the long term it will work. I just don't believe that in the long term, investing in mutual funds, an advisor that charges 1 and 1.5% to put you in actively managed funds that cost 60 basis points, 100 basis points, maybe more, will do better for you. I don't think it's possible. But I think they'll try as a way to get more business. We'll see. But I do think the basic asset allocation plan and rebalancing, it's a commodity. Computers should take it over for us. And there's no reason to be paying someone 1 or 1.5% to be doing that for you. Anyway, that's my view. And that's my take on robo-advisors at a high level. They are basically the 21st century of target date retirement funds. They're pretty slick. I think they do a very good job in a lot of fronts. They're not perfect. As I said, it's very difficult to find one that can manage all of your investments exactly the way you want to. So there will be some trade-offs. As Ace mentioned, you may trade off some flexibility, or you may decide no, you don't want to. You're not willing to trade off that flexibility, and you'll continue to do it yourself. Costs are an issue. I think costs are pretty low, but they could get lower. I think 15 basis points, which is the lowest cost I've seen, and I think that's a Betterment account. I believe it's if you have 100,000 or more, but you'll want to check me on that. I think that's pretty reasonable. I think 50 basis points is not crazy, but it's at the high end, in my opinion. Again, that's for a Robo Advisor, not a human advisor. But costs are an issue. As Ace mentioned, he can get funds at the TSP for a couple basis points, and so that's a factor that he's going to need to consider. How much should he be paying, and should he be directing more of his money to the TSP? And maybe he should. Costs are always a factor. I do think over time, even the costs of robo-advisors will come down. I mentioned one the other day called Acorns, which is a very unique kind of robo-advisor, but I mentioned their costs are 50 basis points plus $1 a month. That's just too high. That needs to come down. There's no reason for it to be that high, but I think it takes some time for these robo-advisors to get enough money under management, and as they do, those costs will come down. By the way, I think I mentioned this, but Betterment's costs used to be higher. I even talked to Jon Stein, the founder. Let's see, this was back, I want to say 2010 or 11. It was at a bloggers conference, and I said, I love what you're offering. It's just too expensive. And he understood that. He knew that the costs would eventually have to come down, and they did. They lowered their costs significantly. I think the other robo-advisors will follow suit over time. I think Wealthfront at 25 basis points, I think that's reasonable. I think those that are higher, they eventually will come down, but costs are always an issue. Always got to factor those in to your decision. So there's my take. If you have comments on this, don't hesitate to shoot me an email, dr@doughroller.net. And as I said, I am going to put together another podcast in about a week or so that kind of talks in more detail about the specific robo-advisors, the pros and cons of each, what I think about them, what I like, what I don't like. If you have views on that, I'd love to hear them in advance of my recording that podcast. I'll probably record it in about a week. So if you've used a robo-advisor, shoot me an email. Let me know what you think. I'd love to share it with everybody on that episode of the podcast, dr@doughroller.net. Well, listen, I hope you have a great Thanksgiving. And until next time, remember, the best thing money can buy is financial freedom.